Hello and welcome back to Data-Driven Finance, brought to you by Yodlee. I'm Mike Stiles, and my guest today is David Silberman. Now, if you want to know about David's accomplishments, just pull up a chair. He's a visiting lecturer in law at Yale Law School, senior advisor to the Center for Responsible Lending and the Financial Health Network, as well as an advisor to many other organizations. He's taught and lectured at Georgetown and Harvard and was the Consumer Financial Protection Bureau's Associate Director for Research, Markets, and Regulation. David, I'm sorry that you really haven't accomplished much in life, but it's great having you with us.
Great to be here, Mike. Thanks.
Well, I think the best place to start is with those two organizations I mentioned. What is the Center for Responsible Lending, and what exactly does it do?
So the Center for Responsible Lending is a advocacy and research organization focused on promoting financial fairness and economic opportunity for all. Issues of particular interest to it involve mortgage lending. It was one of the first way back before the mortgage crisis began to sound the warning bells about the coming crisis. It also has a lot of focus on small dollar loans, such as payday loans, and on student borrowing and the impact that student debt is having on people's financial lives.
There is a research element to it. What kind of things does it tend to study? And has anything come out of its research relatively recently that you found kind of especially interesting?
Yeah, sure. So the research focuses largely on the issue areas I've just mentioned, although the Center for Responsible Lending has just set up what's called the Julian Bond Institute for Financial Equity Research, which is going to be doing a lot more research around issues of financial equity planning, beginning with a large-scale survey that's being planned for later this year. But there have been the most recent work that sort of intrigued me involved a couple of new products on the financial landscape. One's called Earned Wage Access, and this is a product where for a worker who's paid biweekly, has earned money but has not yet received money because it's not yet payday. The product, working through an employer and a fintech, enables the employee to get the wages that have been earned or a portion of the wages that have been earned, and then the subsequent paychecks get reduced by the amount that the employee has already been paid. The second product is called direct-to-consumer advances, although sometimes it's also called earned wage access, although I think that's a misnomer. And it's really a small dollar loan in which a consumer authorizes the provider to link their checking account to the provider. The provider can see cash inflows and outflows, estimate how much money the consumer will have when their next payday is and how much money the consumer will have, and make a loan, which can then be automatically repaid by an automatic debit at the next payday. So those are two somewhat similar products, and the question has been, what happens to consumers who use those products? So the Center for Responsible Lending was able to get data, collaborated with a nonprofit called SaverLife, whose members link their checking accounts, and on an anonymized basis, the Center for Responsible Lending was able to look at these data, identify consumers who were using one of these products, and examine how much they were using the product, whether they were using both products concurrently or just only one product, and some various kind of outcomes. What happened to, for example, overdraft usage in the checking account after the consumer began using those products. So it's kind of interesting research that shed some new light on how these products are functioning in the market.
Yeah, and what did you discover through that research?
I guess a couple of things. Usage patterns were heterogeneous, that there's some people who are using the product occasionally, some people who use it very intensely week after week, and stack several loans on top of each other. Consumers who, before using the product, one or both of these products, had previously been overdrafting their checking account, the incidence of overdraft actually increased for that group of consumers. And consumers who had been using payday loans prior to starting to use these new products, their usage of payday loans increased. So the products seem not to be functioning as substitutes, at least for this subset of consumers who are already using other kinds of alternative financial services, but rather as additional sources of credit.
Okay. Well, and same question, what is the mission of the Financial Health Network?
So Financial Health Network is an organization. It's somewhat similar in terms of mission. Its goal is to help design or to catalyze solutions that advance financial health for all people, with a special emphasis on those who are financially vulnerable. Like the Center for Responsible Lending, it has a research arm that does research focused around issues of financial health. And its attempt to affect change is less through advocacy, although there is a little bit of advocacy, and much more through working with financial institutions and employers to encourage them, prod them, help them develop solutions that will improve the financial lives of their customers or their employees.
So, well, now we got a feel for the spaces that you've kind of had a front row seat into watching. Where are we in terms of having a robust mortgage market, a robust lending market that really works for both lenders and borrowers? I mean, what needs to happen to improve that process?
So I'd say we're a ways away from having a robust mortgage market. And I think about the mortgage market in two terms, in two ways. One is, what is it doing? What is it able to do to enable people who want to become homeowners to become homeowners? That is, by extending mortgages. And the other is, what is it doing to help existing homeowners retain their homes or remain homeowners, particularly in the face of financial shocks, loss of income, unexpected expenses, which may make it difficult for people to make their mortgage payments. So if you think on the first dimension, I don't think it's any secret that we have a huge affordability issue, given what's happened to housing prices, given the limitations on housing supply, and given where interest rates are. A lot of people who want to become homeowners simply cannot afford the monthly payments today. That's less a function of the mortgage market as such, as it is the housing market on the one hand, and the way income and wealth are distributed on the other hand. So for those reasons, it's a very challenging time for people seeking to become homeowners. There are things that can be done at the margin that would make a difference. There's some people who have the income to support a monthly payment, but who simply don't have the upfront capital to pay for a down payment and closing costs. Down payment assistance can help there. There may be some people for who have the income, but where their credit score is a problem, and hopefully we'll get to talk about a little later. Innovations in underwriting and credit scoring may be able to help there. But the core problem of affordability is something that's sort of beyond the capacity of the mortgage market per se to solve. The home retention issue, that's something where I think a lot of progress has been made in the last 4 or 5 years in developing solutions that enable people who hit financial difficulties to maintain their homes, to get temporary forbearance so that they don't have to make monthly payments for a period of time, and then to put the money that they owed but weren't able to pay at the back end of their mortgage, so that when they sell their home or when they finish their mortgage, there's an additional amount of money due, but in the meantime, they're able to keep staying in their homes. And those programs have been quite successful in reducing unnecessary foreclosures and helping people to stay in their home.
I assume when we talk about responsible lending, that's about making sure lenders don't make risky loans or loan to people who are likely to default. Just overall, like you said, avoiding 2008 all over again. What are lenders doing to get better information and data to make better loans? Where are they getting that information?
So I think there's two things that are taking place. One is bringing new types of data into the credit reporting system, so that credit scores are more robust indicators of one's ability to repay. And to be more concrete about that, traditionally, credit scores are based on what the information in credit reports, and credit reports, as the name implies, have really only contained data from lenders. But people have lots of other ongoing obligations that they pay. A good history of paying rent is a good indicator that somebody's going to be able to pay a mortgage of similar cost. But rent data has never been in the credit reporting system before. So simply bringing that data into the system through various means improves the quality of data available to lenders and the quality of the credit scores. The other thing that is beginning to happen, less so in the mortgage market than in some other lending markets, is what's called cash flow underwriting. And that is obtaining data from one's checking account to see cash inflows and outflows and understand somebody's economic, their current economic situation, and that, at the very least, is a good complement to credit scores, which are backward-looking and looking at historical performance, to provide more robust data to assess somebody's ability to repay.
Yeah, it sounds like on the other side of the coin, it's not only helping lenders make better loans, but on the consumer side of things, it's giving a more accurate picture, and sometimes that's a better, more positive picture of their financial history and behavior than they were being, given consideration for before.
Absolutely, that's right. I mean, credit scores have a couple of weaknesses. I mean, one is there's a substantial number of people who don't have a credit score, either because they don't have any credit or don't have sufficient credit to generate a score. The Consumer Financial Protection Bureau recently reported that about 12.5% of people in the United States do not have a credit score, I'm sorry. Second, there's another group of people who have a credit score, but it's based on relatively limited information because they've only had, say, one loan for 6 months. And those scores are not especially reliable. So providing more data from rent payments, utility payments, payments of telecom bills will enable more reliable scores. And third, as I indicated, credit scores are inherently backward looking. They're based, if you had a problem in the past, it's going to affect your current score. So it's a lagging indicator of your creditworthiness, your ability to repay. So there's some people who they may have had difficulty. It led to some delinquencies. They've recovered. They're now actually in good financial shape, but their credit score hasn't yet caught up with them. And so these new data and new methods of underwriting will help them. Conversely, there may be some people who have just hit financial difficulty and are struggling with their finances, but it hasn't yet shown up in their credit report. And so their credit score may overstate their ability to repay. And for those people, these new data may actually make it harder to get a loan, but harder to get a loan that they would struggle to repay if they got it. So it's at least a mixed blessing.
Yeah. For those borrowers who are qualified, has technology made, or is it starting to make it easier to go through that lending application and approval process? Because historically, it's been a gauntlet, even when it goes really well. I mean, it's a really excruciating thing to go through.
Yeah, that is certainly true. And even with all the technology we have today, there's ultimately still a whole stack of papers that people are going to have to sign or virtually sign. But technology has made difference, at least in some respects. One of the things that's required these days to get a mortgage is that the lender has verified and documented the consumer's income and assets. That used to be a manual process that can now occur electronically if the consumer provides access to payroll records or to their checking account. The lender can verify the income without having to go through this manual process. For some sales, a second requirement for mortgage is that the lender needs to know the value of the property that you are buying to understand whether the mortgage is, what percentage of that value the mortgage is. Will be. That traditionally has required getting an appraiser to come out and appraise the property. The appraiser looks for comparable sales and comes up with a valuation. There are now automated valuation models which can estimate housing value without having to go through that process. And they're being used in some percentage of cases, not, as I say, an overwhelming majority by any means. And then the third thing that's happened is that it's e-closing, so that instead of having to go down physically to a lawyer's office or a title settlement office to sign all these papers, there's ways to set up a closing online with e-signatures, and that's certainly a convenience, although it doesn't ultimately reduce the burden of what you have to do, other than reduce the travel time to and from the office.
You touched on something earlier about a lender's ability to access and watch borrowers or potential borrowers' cash flow. And Yodlee deals a lot with cash flow data and connecting people to that. If lenders did have access to quality cash flow data, what exactly are the things that they would be looking for in that data to help them make the decisions, set the rates, et cetera?
So, I mean, at the highest level, they're looking at what the data would tell them about whether the consumer has the income, unrestricted income that's not already committed to other obligations, to pay a new debt. So that means looking at cash inflows, looking at outflows, identifying the rent payment, seeing how large the rent payment is and how the mortgage compares to the rent payment, if it's a mortgage. If it's going to be a personal loan, just seeing how much income there is and how the income's going out. The second thing that the data can provide is another window into the consumer's regularity of making payments. So for things that are not reported to credit bureaus, like rent and utility payments, you can identify, is the consumer each month making the rent payment on time? Is the consumer each month making a utility payment on time? Now, you can't tell from the data whether the payment is 100% of the amount that was owed, at least for utilities where the money can fluctuate, but you can at least see a recurring payment pattern. And so that gives you additional information about the consumer's history of repayment, which is the other thing that goes into an underwriting decision in addition to their current financial capacity.
It seems like there's a balance to be achieved from lenders, from not making irresponsible loans, not putting people into loans that they're going to eventually probably default on. But then there's also the aspect of inclusivity, which you mentioned, some of your organizations look to improve. So how do you do that? How do you raise that level of inclusivity while still making responsible loans?
I mean, I think you're exactly right in terms of that there is that challenge. And I think the best you can do is through the kinds of things we've been talking about, that if you have reliable data that provides a picture into the consumer's current financial situation, current income and expenses, and their payment history across a large range of different kinds of obligations, you have the best possible data on which to make decisions. If you then bring into that sophisticated modeling techniques, algorithms, machine learning, what have you, to try and make the best use of these data, you can enhance your ability to make appropriate loans. There are clearly potential biases in the data in the system. So there's a recent paper that was just published where the researchers, I think for the first time, were really able to get credit score data, credit report and credit score data, and link it to tax records so that they had income, link it to parental income, and then to race, data on race and ethnicity to understand how the credit system is working. And one of the interesting findings there is one of the things the researchers did is they identified a set of people who, for a 4-year period of time, had no delinquencies on any loans. And they looked at what those individuals' credit scores were at the beginning of that 4-year period and found that the Black consumers within this group had credit scores that on average were 70 points below the white borrowers in this group. So that indicates some kind of bias, if you will, in the algorithm. And there are techniques that can be used to debias, to try and achieve predictions that are as accurate as possible in terms of ability to pay and repayment, but also minimize the kind of disparities that might otherwise exist. And those are all things that can be done to try and achieve inclusivity without going overboard, if you will, or without making loans to folks who are going to wind up unable to repay those loans.
It's a really good thing to aspire to. David, from all the experience that you have and all the different roles that you've played, what do you come away with thinking, what does financial health mean to you? I mean, because I bet if you ask 10 different people from 10 different demographics what their definition of financially healthy is, you'd probably get very different answers.
I'm not actually sure, Mike, whether you'd get very different answers or whether what you'd get would be very different words to express essentially very similar concepts. Certainly in the literature that talks about financial health, folks use different words. Some people talk about financial health, some people talk about financial well-being, some people talk about financial security or financial stability. But when you peel back, I think people are saying 3 basic elements. I mean, one is the ability to meet your current expenses. So routinely positive cash flows. Your income is above your expenses. The second is resilience, the ability to weather a financial shock. So if you are out of work for a few weeks and are not getting paid, or if your car breaks down, there's a major expense, you're not thrown for a loop and sideways. You have resources to cope with that. And I think the third element, and this is the one where there may be more difference as to exactly how you define it or what you mean by it. But I think about it as making progress on track to achieve longer term financial goals. So it's hard to think of somebody as being financially healthy if they're in the moment, they're fine and they have some resilience. But when it comes time to retire, they're going to be up the creek because they have no retirement savings and no pension. But on the other hand, I wouldn't say you're not financially healthy if today you don't have enough money to retire on. You wouldn't expect a 30-year-old to today be able to retire. But making progress towards these kind of longer term goals, and that's sort of more amorphous thing to measure than the first two elements. But I think that's the third element of financial health.
Obviously, the way we bank and conduct our finances looks very different now than it did even 10 years ago. Just so many innovations, the technology that's come forward that's been applied in fintech and online banking and things of that nature. What are some of the advancements that you've seen that pique your interest? And what are some of the things that kind of make you say, this probably needs more guardrails or caution?
I think about that question. It's a great question. I think about that question from the perspective of those who are living financially precarious lives, paycheck to paycheck, struggling, some just getting by. Those are folks who, on the one hand, have least slack in their budget, so the least ability to handle disruptions, but also probably have the least bandwidth to focus on these such of things. Technology has made life a lot more financial lives a lot more complicated than it used to be. When I was starting out, I had a checking account, and every 2 weeks I would go to the bank and I'd deposit the check, and they would give me a paper slip with the deposit slip, and I'd go back and enter in my checkbook the amount of that deposit. I would cash a check or pull money from an ATM. I'd get a little slip that showed me the withdrawal, and I'd enter that in my checkbook, and then I'd pay for things in cash, or I'd write checks occasionally. And when I wrote check, I would just enter that in my check register, and I would have a running tally of how much money I had in my bank account. Today, that's virtually impossible given the multiple ways in which money comes in and comes out of accounts without any in the moment visibility. Debit card transactions, ACH payments, direct debits, direct deposits, remote deposits, you name these various things. So it's very hard to keep track of your funds in that way. And as I say, for those folks who are living at the edge, that's a particular problem. So certainly mobile banking and apps where you can go on and see in a moment how much money you have in the account, those are very helpful. But they actually can't tell you what about the debit that's coming in that you've authorized on either a recurring basis or a one-time basis that's about to hit, but it doesn't yet show up in your balance? Or what about the check you wrote that hasn't yet cleared? So it's an incomplete picture. But apps, personal financial management apps, which are able to ingest data from your checking account and using artificial intelligence, anticipate what kind of expense, what's coming in and what you're going to need to what's going out, and help people understand how much is safe to spend, what they need to do to get ready for the next payment that's about to hit. And if there's some opportunity, how to optimize what they're paying in order to reduce their cost. I think those are all technologies with enormous promise for this vulnerable population on which I'm focused.
Well, lastly, I think about younger generations like Gen Z. They're looking at their financial prospects. It feels like if you're in your early 20s and you have a desire to start building wealth by buying a home, you are in the perfect storm where home prices are against you, mortgage rates are against you, inventory is against you, you're young, so your credit score may be against you. Would you have any advice for, someone in that age bracket who wants to start building that financial health, but is seeing that home ownership may not be as accessible as it was for like our generation?
Well, one possibility is to see if you can find some rich person to adopt you.
Yeah, I tried that. It didn't work.
Yeah, it's really if you can make it work, it's a great solution. But this is going to be a slow but steady process here. So the only way you can save or invest is if your expenses are less than your income, right? That's tautologically true. So if you want to be making progress on saving or investing, the first thing you need to do is actually try and manage your expenses in a way that enables you to have some cash money left over at the end of the month. If you can get in a regular savings habit where you're committing to set aside a certain amount of money each paycheck each month, that's better than simply saying, hey, seeing what happens to be left over at the end of the month. So that means budgeting, having visibility into how you're spending money and thinking about it. I'm not saying, you need to lead an austere life. It may be that if you're really 20, 21 year olds, it's just starting out, it's too early to be saving. That essentially when you're saving, your future life, you're giving money from taking money from your present self and giving to your future self. And there's definitely a time in life when you need to do that. It may be 21 is a little early, but you want to, as soon as you can, get in the habit of doing that, saving, investing. I guess the other thing to the extent you're investing, I would say not to try and outsmart the market. That rarely works as an investment strategy. So don't think that somehow you're going to pick stocks better than anybody else can pick stocks, or time investments better than anybody else. You need to sort of a steady as you go approach.
Well, it's good advice, David. Thanks again for agreeing to be a guest on the show. If listeners want to find out more about these organizations you advise or about you, what's the best way for them to do that?
Well, for each of them has a website, of course. So the Center for Responsible Lending is responsiblelending.org. And the Financial Health Network is finhealthnetwork.org. And I guess for me, you have to Google me and see what you come up with.
And hopefully it's all good.
Well, all good I don't even aspire to, but at least unbalanced.
You're right. As long as there's not another David Silberman out there.
Yeah.
All right, fantastic. Well, for our listeners, subscribe to the show because much is changing and we're right there with you on this ride, talking to the experts. And if you want to see how aggregated financial data might be of great use in your business, just visit resources.yodlee.com/podcasts. And we'll see you next time on Data Driven Finance.